Good afternoon. I'm Brad Newman, and on behalf of the entire firm, we here at Fort Pitt Capital are pleased to present this series of webinars for our webinar series. This is one of a whole lineup that we're doing, and they're really designed to be first and foremost educational. They're designed to touch on the areas of our clients' lives that we talk with them about on an ongoing basis, and also designed to leverage not just our expertise, but the expertise of advisors that we collaborate with on a regular basis. So a number of the webinars have been kind of a Q&A with us interviewing some of the advisors that we work with on an ongoing basis. Just a little bit of background about me. I'm a certified financial planner with Fort Pitt Capital Group. I've been working with clients for about 25 years, helping them quantify and meet their financial goals. So with that being said, let's just touch on a few quick housekeeping items. As always, all lines are muted for the presentation, and questions can be sent in during the presentation. If you're on a device like an iPhone or an iPad, you can go down to the bottom of the screen and bring up the button for questions. If you are on a computer, there's an orange arrow in the upper right-hand corner that brings up buttons on the side, and use the one for questions. And we'll address questions at the end of the webinar. Any questions that we're not able to get to, depending on the volume, we'll follow up with you directly afterwards. So just a quick, note or maybe disclaimer to Fort Pitt clients. I know we've got a lot of folks on the line that work with us already, and the topics that we're going to cover are really going to be a review for you, most likely. You're probably familiar with a lot of these concepts. You've probably spoken with them about them with your advisor, but for all of our Fort Pitt clients, certainly please feel free. If you think this would be useful, don't hesitate to share it with friends, family, colleagues, people that maybe don't know some of these concepts. And I believe that a link will be emailed to you directly after the webinar, so please feel free to pass that on. So just a little bit of a preview, kind of what we're going to talk about today. The first part of the webinar, we're going to look at some planning concepts and some key factors to be thinking about as you go through the process of determining how to choose an advisor. And then in the second part, we're going to dive into some broad portfolio management and investment process type concepts. So with that being said, let's dig in. And the first slide for the actual presentation, this is something that's I kind of stole from Who Wants to Be a Millionaire with Regis Philbin. I don't know if anybody remembers that show, but when they would get to these big money questions, there'd be this dramatic music, and then Regis would ask, "Is that your final answer?" And the whole thing, it was designed to throw people off their game a little bit, make them a little bit nervous, make them really stop and think before they proceed. And I guess the point for starting here is so many retirement decisions are really once and done decisions. They're decisions that you only get a chance to make once, and they're irreversible. You don't get a second bite at the apple. And so what I'm talking about are things like if you're fortunate enough to, have a pension, it's not just important that you make that decision about your pension election and make it right the first time. It's also important that that decision isn't made in a vacuum, that you understand that every single decision that you make impacts another decision somewhere along the way. And it's really critical to coordinate these decisions, and not just decisions for assets and events in your life, but if you're married, to coordinate across what's going on for you and your spouse. So with the pension as an example, if somebody dies unexpectedly, early, or somebody lives longer than what you're planning on, the cost can be hundreds of thousands of dollars. And that decision that you made at retirement is irreversible. It can't be changed. Another good example of that is Social Security. And essentially at a high level, your decisions are to either take Social Security at full retirement age, or take it at early for a reduced benefit, or delay it beyond full retirement age for a higher benefit. And again, these decisions need to be made based on not just your situation, but also how's that going to be influenced by your marital status? How's it going to be influenced by difference in age between you and your spouse? Difference in historic earnings between you and your spouse, and really overall funding levels for retirement. So there's a lot that goes into making that specific decision. This is a topic that's complex enough to be its own webinar, and we actually did that several weeks ago. And if you're interested, if you weren't able to attend, if you go to our website, at the bottom of every page, there's a link, there's a YouTube link, a little icon down there. And if you go to that, you'll be able to see all of the webinars that we've done historically. Rolling over a 401k is another decision that you really can't go back in time and undo. So there's a lot of things to be that go into that decision. For example, if you're retiring before age 59 and a half, might you want to take distributions from those dollars? If you roll them into an IRA, it becomes problematic. If you're working a little bit kind of post-retirement income, and depending on your age, if you're in the RMD or required minimum distribution window, that decision to roll that 401k over could be impacted by that. And then the other two things that we talk about are, I'll kind of start with even the decision to retire. From what we see in working with our clients, it's really rare that you're able to re-enter the workforce at a comparable position with similar benefits, similar income, that once you leave the workforce, it's really difficult to get back into it. So I think as you're going through this decision-making process, one of the real critical ones is, am I sure that I'm going to be okay, to retire? The other one that's listed there that we call deceleration into retirement, that's a little bit of a newer concept maybe, that we're seeing an awful lot of clients that are saying, I don't want to continue to work the way that I've been working, but I don't know that I'm completely ready to flip the switch and fully retire. So we're seeing a big movement where people are interested, either if they have a profession that they really enjoy, kind of scaling back. They're going to be willing to spend less time doing what they've done, have less stress, also earn less money, but maybe do it a little bit longer. We also have another group of clients who have said, my career's been really good to me financially, but if I'm really honest with myself, I've never truly enjoyed what I did for a living. So I think I'd like to have a reboot. I'd like to have a second career, maybe something in the nonprofit world or something completely different. But the basic concept is, instead of saying, my plan is to retire at 65, and when I hit 65, I'm going to be done, starting that process earlier, maybe somewhere in your mid-50s, and saying, I'm going to pare back or do something different, but I'm going to do it a little bit longer. So as opposed to retiring at 65, maybe I'm working till closer to 70. And again, the idea of doing this is really great. There's sometimes some financial benefits to doing it. There's a lot of emotional benefit to doing that as well. But the key is to look at that ahead of time, coordinate that decision with all the other things that are out there, and figure out if it's something that's really workable. And the best way to do that is with a comprehensive plan. And that's something we're going to be touching on over and over again, that it's really important to go through that process so you can kind of get a preview of what the impacts are, what the results are, kind of how that's going to work. So let's talk about how we go about doing that. And we've already talked about some of these irreversible decisions, but these other boxes give us, a look at some of the other things that are out there. How do you compete, or how do you kind of prioritize against competing goals? Maybe helping parents who are still alive financially, maybe helping adult children. Maybe there's a lot of charitable things that you're interested in doing. And that's really where the benefit of doing that plan or doing those retirement projections comes into play. The real purpose is to kind of quantify what you're doing. And the idea behind it is it's going to tell you if you're on track, and it's going to tell you what your limitations are. Maybe you can do some of the things you want to be doing, but maybe not all of them. And depending on where you are, I guess, life cycle wise, what corrective measures can you take? And that's really one of the benefits of starting that process early, is that you can evolve, you can make tweaks as you go to make sure that you remain on track, or you get on track for doing what you want to do. The two boxes there in gold are really the two most common questions that we address for clients. And quite frankly, those are the two questions that really bring clients to us, that a lot of clients kind of wake up one day and realize that retirement is no longer this academic exercise. It's really something that is happening. And their first question is, well, what is a sustainable retirement income? And that question is followed up directly by, how much risk do I really need to take to do what I want to be doing? And by answering those two questions, that's when we can really begin to make some decisions on portfolio construction, and how your investment piece is going to work. The one thing I'll say on this is we are absolutely firm believers in not taking more risk than you need to reach your goals. And I think that's a really hard concept for some people, and we've just been so conditioned our whole lives to save, 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 and grow, grow, grow when it comes to our portfolios. And it's really hard to take that step back to say, maybe I can take my foot off the gas on the growth component, because by doing that, even though it's going to be okay, you have to be comfortable with the fact that you're probably going to be leaving a little bit of return on the table. So just be prepared as you go through this process. Doing proper planning is a lot of hard work, but the benefits are significant. And I can't stress enough how critical it is that the components of a good plan are that, first and foremost, it's based on your specific needs and goals and situation. And secondly, that it's reevaluated on an ongoing basis. Just remember that a plan is really a living, breathing document. It's not a once and done exercise. It's got to be refreshed as your circumstances change. So with that being said, let's look at kind of shifting gears a little bit into, as you're looking at hiring an advisor to implement this plan, a few different potential conflicts of interest that are out there that you should be aware of. The first two are really, excuse me, kind of buyer beware situations. Some of these are going to be a little bit more overt than others, but it's important to do your due diligence. The captive menu of products and sales quotas really kind of go hand in hand. The captive menu of products are really where a company has negotiated with, let's say, a mutual fund company, that the more business they put with that company, the higher their compensation is. And typically when you see that list of options, or maybe you don't see it, but it's happening behind the scenes, just know that a lot of times that's really based on compensation for the company, not necessarily what's going to be the best investment options for you. In a similar vein, on the sales quota side, these are really used to push advisors to sell a certain amount of product lines, to sell life insurance or sell annuities or mortgages or things of that nature. The Wells Fargo issues the other year were a great example of that. That was probably an extreme example, but understand that on some level that may be occurring, and that it's not necessarily based on what might be in your best interest. Some of the other ones we're going to dive into in a little bit more detail, things like annuity sales, which are unfortunately often driven by the high commission nature of those products, and some of the other fees like sales loads and 12b1 fees that you just might not be aware of. So let's dive into the annuity portion a little bit. And people are routinely asking us if annuities are a useful part of their overall plan. And the answer is, like most things, sometimes, or maybe. So for example, there's going to be situations where if the real focus is doing, let's say, asset protection from nursing home costs, there are annuities out there that can be, very useful in doing that. Unfortunately, what we've seen is annuities being really probably the most over and incorrectly sold investment out there. And kind of as this slide is getting to, there's a huge allure to these guaranteed returns. And especially during a year like 2020, where we've seen extreme volatility, that's a really, really nice environment for them to say, well, wouldn't you like this guarantee of X%? But I think the real key is to understand, the costs inherent with that, and also the limitations that you face in terms of flexibility, inside of these annuities. So let's look at the expense side of things first. And we're certainly not going to go through each one of these fees in detail. But the point is, when you look at that guarantee return that's being advertised from the annuity, I think your first move is going to be to add up all those embedded fees inside the product, back them out of that guarantee, and then really see how appealing does that guarantee look. On the liquidity and inflexibility, I think there's really 2 points to be made here. Once you annuitize that annuity, in other words, you say, I'm going to trade that lump sum of money that I gave the insurance company for a set monthly income, you're really locked into that monthly distribution without the ability to change that distribution down the road, or to take lump sum distributions. You've just locked yourself into that monthly rate in most cases. And prior to annuitizing it, you might say, well, maybe I'm going to have a little bit more flexibility there. And you are. But I think the other thing, and here this surrender fees section of it is critical, that once you put dollars into an annuity, there's what they call a surrender charge period. And that can last for, sometimes 8 to 10 years, where if you want to access those funds during that period, you're not going to be able to get your funds out dollar for dollar. There's going to be a surrender charge. Sometimes it's as high as 8 or 10% in the first year, and typically it declines, from that point on. But the point is, you really need to think through that decision of putting money into that annuity as far as what are some of the other things I might need that money for. Am I comfortable with the inflexibility that I'm, subjecting myself to? And again, that comes back to, that plan that we've, that we kind of addressed early on. And then the final issue that we see there is the quality of the investment options. And I guess I'll kind of compare that annuity to an investment account that you might own, or an IRA, something where you can go out and use any investment you like in it. Once you put dollars into that annuity, you're really limiting yourself to the investment options that the annuity company provides to you. And from our experience, they're typically not putting their best performing funds inside that annuity contract. Their best performing funds are getting plenty of assets on their own. So they're typically putting funds in there that they need a little bit of help getting assets contributed towards. But the point is, really, you've limited your options. You're now going to have to pick off of the lineup that the insurance company provides to you. So just a little bit there in terms of annuities. On the fee side, I think the first thing it's worth noting is I'm not saying that all fees are bad inherently, but what I am saying is that if there is a fee that you're subjecting yourself to, it should provide some benefit to you. So let's take a look at some of the fees that are out there that we see as typically not adding a lot of value to, you as the investor or you as the consumer. And the first two are sales loads and 12b1 fees. And at the end of the day, these are really commissions that are paid, either commissions on the front end or commissions on the back end, essentially for the privilege of buying a product. And the way things are today, those are fees that we think might have outlived their usefulness. The other fees that are there are fee sharing arrangements and soft dollar compensation. These are either going to be typically cash or tangible, payouts to advisors or to a company for hitting sales goals. And again, as we were talking about a little bit earlier, we just don't think those are going to be fees or costs that are inherently in your best interest. At the end of the day, some of these costs can really eat into returns. And if they're not providing direct benefit to you, we really have to scratch our head and say, why are we even participating in them? So let's take a look at sales loads as kind of an example. And this is a slide of two different share classes for an American funds mutual fund called the Growth Fund of America. And it's actually a pretty popular fund in 401ks. So it may be something that you're familiar with. But the point is, if we look at this over a 1-year period, kind of October of 19 to October of 2020, here over at the far side, you can really see the impact of that initial sales charge. And the initial sales charge is listed down here. It's the maximum that's allowed of 5.75%. And the point is, you might assume that you get to the end of the year, the differential in return for that fund over that 1-year period is going to be that 5.75%. In actuality, that difference is almost 7.2%. And you might say, well, why the differential? And really the differential comes from when that sales charge or load was taken out up front, that limited the amount of dollars that we're getting interest or dividend or investment return over that period of time. And so from 5.75% up to almost 7.2%, that just shows you what's happening over that 1-year period. Imagine if you compounded that out over 10, 20, 30 years, it becomes really, really difficult to make that up. So we think that's something that's really, really critical to look at. And I think next, maybe it would make sense to kind of broaden the conversation a little bit, and let's talk about just overall advisor compensation. And I think this is something where it's there's more information out there about this than certainly there was 10 or 15 years ago, but it's really important that you understand what it looks like in the relationships that you're dealing with. So there's essentially three different kinds of or three different ways that advisors can get paid. The first is on a commission basis. So this is really how the world used to work almost exclusively years and years and decades ago. The life insurance industry is a great example where historically the life insurance agent didn't get paid anything unless you purchased a product. And it was a pretty transparent relationship. You kind of knew what that looked like. The second way is, and this is how we've established ourselves at Fort Pitt Capital Group, as a fee-only investment advisor. And we think it provides all the transparency, and essentially clients pay us a percentage of assets that we manage to manage their portfolio. And what mutual fund, what stock, what bond we use really doesn't come into play. So it really puts us on the same side of the table as you, the client, that the things that we're doing, it doesn't impact how much we get paid at the end of the day. And the third main one is fee-based, and that's essentially going to be a hybrid between the two. And how you're being dealt with could change, depending on what account you're dealing with or what product inside an account you're dealing with. But it's really incumbent upon you to understand, how am I paying my advisor, and is that payment structure aligning their actions with my interests or not? To help you with that, we did pull together a list of, we call it vital questions to ask your financial advisor. I think these are questions you can ask either a current advisor, or certainly as you're out looking for a new advisor, something you want to make part of that discussion. So we've really blocked it out into 3 groups. There's a section here that talks about fees, a lot of the things that we just covered. There is a section that talks about, we call it ethics, kind of whether they're held to a fiduciary standard, have they ever had a regulatory complaint against them or their firm. And then the final piece, kind of from a service standpoint, where you really want to be getting at a little bit of, how does this firm operate? How do they work with you as a client? Some of the things that I mentioned as far as, are they doing investment work in-house? Are they farming it out to somebody else? But these are really good questions for starting those conversations. So now that we've covered a little bit on the planning and a little bit on what to look for in choosing an advisor, let's turn our attention to what we feel is a prudent investment process. And from our perspective, the investment process really kind of involves 3 different segments, or 3 different pieces. So the first piece is an overall investment policy. And this is really, we think, the key decision to the entire process. And it should be solely dictated by your personal situation, not what the stock market is doing, not what the economy is doing, but this should really be working hand in glove with that planning that was done initially. And the real goal is to set an investment policy that allows you to reach your goals with the least amount of risk needed. And this is what's going to really dictate kind of our stock to bond ratio at the highest level of portfolio management. And the one thing that I'll say with this, and again, this kind of goes back and mirrors some of the things that I mentioned on the planning side, is, understand that this is not set in stone. This is something that needs to be revisited at least annually, or as your circumstances change. So as goals change, as timeframes change, as portfolio values change, that could have an impact on that investment policy. And it's also appropriate, we have a lot of clients that have more than one investment policy. They may have one that dictates what they call, quote unquote, their retirement dollars. And then they're going to have another if they've got dollars set aside for their grandkids' educations, or dollars they have set aside for charitable interests. So just think of it that each bucket of money that you might have is going to have possibly a different goal. And if it has a different goal, a different investment policy would be reasonable. The next piece is the asset allocation shifts. And this is really, where we're making the decisions about what the complexion of both the stock and the bond side of the portfolio look like. So on the stock side of the portfolio, it's things like how much is going to be in dedicated foreign versus domestic, how much in large, mid, or small cap stocks, what is our sector weighting distribution look like. On the bond side, it's going to be, are we using corporate or municipal bonds? Are we having a long or a short average duration, a high or low credit quality? And I think the real point with those allocation decisions is, much like the investment policy, not set in stone, they need to evolve over time. And then the last piece of it is security selection. And that's where we're getting down to to focus on how do we kind of express the portfolio that we want to build. What stocks, what bonds, what mutual funds, what exchange traded funds are we using to do that? And you know, the heavy lifting has been done. By the time we get to security selection, it becomes almost a natural progression of the process. But as we'll talk about in a little bit, it's really critical that we get that right. So let's take a minute and kind of dive into a little bit more detail on the asset allocation side and on the security selection side. I just want to be really clear on the asset allocation portion that what we are not talking about is market timing. You know, we're not talking about trying to move in and out of markets, in and out of asset classes. What we're really talking about is very incrementally adapting the portfolio to the ever-changing environment that we live in. And, you know, a good example that we can look to for the last 3 years is, you know, foreign versus domestic stock exposure. And the point isn't to say, you know, here's what we did or here's, you know, what should have been done. The point is really to provide an example where you can see over that 3-year period, there's more than a 40% spread between how domestic stocks and how dedicated foreign stocks have performed. And the point is, if you've got an allocation that is completely static, you're missing an opportunity to make some adjustments to these types of changes that are going on all the time. If we take a minute and dive into the security selection, like I mentioned, you know, here's where we're going to see essentially, are you being rewarded for the risk that you're accepting? And the example we're going to look at comes out of the mutual fund world, which has done a really good job of being an environment where you can evaluate funds with similar investment categories to see, you know, how is one fund doing versus another within that same peer group. So, for example, if you made the decision last year that you were going to invest a part of your portfolio in large cap growth style stocks, let's take a look at what the impact could have been. Now, you're probably feeling like you're about to be set up, but if last year you had a large cap growth stock that had a return of about 27%, you'd probably be feeling pretty good about that, right? Don't answer. But yeah, 27% in a vacuum is a really, really nice return. But let's take a look at what that means. That 27% return, when you look at the 1,300 large cap growth style funds that were in existence last year, that puts you squarely in the middle or the median performer of the bottom quartile. If you would have had a fund that came in at the median performer of the top quartile, it would have had roughly a 37% return. So we're talking about a differential of approaching 10%. And from our perspective, these funds have a similar risk profile. I know they're not going to line up exactly, but we're really zeroing in on 1,300 funds that are investing in large cap stocks, and they've got a growth orientation as their goal. So the real question is, if you're taking a reasonably similar amount of risk, are you being rewarded for that risk? And the thing that we see all the time is clients coming to us with a lineup of funds in their portfolio that are consistently in the bottom half of their peer group, oftentimes in the bottom quartile of the peer group. And clients get a little upset when they realize that. And they would really have no way of knowing, but their question is, well, how could that be? How could that happen? And there's really 3 answers behind that, you know, and none of the answers are great. The first answer is, you know, the advisor knew full well this was a fund that wasn't a great fund, but put it in the portfolio because it simply paid them more to do it. The second answer is the advisor just had no idea it wasn't a good fund and it wound up in your portfolio. And the third answer, although not a great answer, probably the best of the 3, is that maybe this was a good fund initially. Maybe they really had done the work and the research and knew this was a good quality fund, but they never kept up on their evaluation. They didn't continually reevaluate it to see if it still met that criteria. And as things changed, sure enough, it didn't. So the point is, like a lot of the things that we're talking about today, these are not just, one and done conversations, something you can do once and put on the shelf and forget about. It's something that you really have to be thinking about on an ongoing basis. So kind of wrapping up some of these concepts, I think, the first thing I would say is don't be afraid to plan. I think too many people are hesitant to dive into some of these things because they might be afraid that they're not on track to do what they want to do. Maybe they're not going to like the answer when they start digging into it. It's almost akin to, I don't want to go to the doctor because I'm afraid they'll tell me I'm not healthy. From our perspective, even if you go through this type of a process and you come up with an answer that isn't what you want, that's actually a good thing. It's better to know that and be able to deal with it. And if you're far enough down the line from actually retiring, you can really make some hopefully incremental change to get you back on track. If you're further along and retirement is right around the corner, I think it's also positive that you've now got some parameters or guidelines that you're going to have to operate in. But at the end of the day, it's certainly better to know the answers to these questions when you're 45 versus when you're 65, and better when you're 65 than when you're 85. But again, the farther out you are, the more opportunity you're going to have to make change with less impact on your current lifestyle. And this graphic is something that we think really kind of brings it all together, to kind of understand that your retirement plan and your investment strategy need to evolve. That as you see any one of those three pieces change, that means you're likely going to have to reevaluate the other two. And that's the process that we're really going through with our clients on an ongoing basis. The one thing that I will throw out there is we've kind of put together I guess as a thank you for attending the webinar, an offer of a complimentary second opinion on a portfolio, for portfolios of $500,000 and higher. And the purpose there is to just kind of review some of the things that we just walked through, more so on the investment side, to do a little bit of risk and fee quantification, to do a little bit of looking at the efficiency of the portfolio and see if there's areas of opportunity for improvement. It's every time we go through this with a new client or a prospective client, people are consistently surprised with what we find when we go through the process. And we've been able to help people significantly reduce risk or reduce costs, which ultimately improves their overall net returns. So as we kind of look at that, I think we've got about probably 5 or 10 minutes remaining for a little bit of Q&A. David Zabila is another advisor with Fort Pitt who is on the line, and he's kind of been trying to coordinate questions as we go. David, I don't know if there's anything that you're seeing as some common themes on the questions.
Yeah, Brad, a lot of really good stuff that you went over, and there are some questions. Some are specific maybe to someone's specific situation that we can reach back out to them and get more data and answer those. But some of the general ones that would be good for the group. What is the effectiveness of the rules of thumb when you have saved enough for retirement?
Oh, that's a great question. And we actually have people ask that all the time. And from our perspective, there's a pretty good chance that the rules of thumb are not going to apply to your specific situation, but we think they can be a really good starting point for a conversation. And again, not to be too redundant, the end point of that should really be going through that planning process, that it's each individual circumstances are really unique. That even if you look at two clients, and if on paper everything looks identical, chances are their goals aren't identical. So I think those rules of thumb can, again, be a good starting point for a conversation, but I certainly don't think they're the ending point, David.
That's great. And one that's a little similar to that came up, what is a percentage of the portfolio that should be in stocks, say at age 50, 60, 70, etc.?
Yeah, that's great. And that kind of goes into the rule of thumb. There's the, rule of thumb, your age, 100 minus your age will dictate your allocation. And from our perspective, it's just not an age-based decision. Again, the planning, which is based on your specific situation, will help us determine levels of funding, which will then help determine how much risk. But we've got a lot of clients who are, they certainly break the mold. We have some clients who are much older, and they've got, I'll say, a relatively aggressive investment policy or strategy for how we're managing their portfolio. And maybe it's because they're so very, very well, funded and meeting income needs from other sources. Maybe it's pensions, maybe it's real estate income or what have you. And they're really viewing their portfolio as assets for the next generation. So therefore, given that next generation's time horizon, they're being more aggressive. On the flip side, we've got some clients who have maybe sold a business at a reasonably young age, and they've got relatively conservative portfolios because they're really using that portfolio for almost all of their ongoing living expenses, and they're a little bit more focused on that consistent yield and wanting to make sure that they're not outliving their dollars. So again, I think it's another good example where it can be used as a conversation starter, but probably not a conversation ender.
That's great. And then, on the accumulation side of it, can you go over the differences between using a 401k to save for retirement and a Roth IRA?
Oh, sure. Okay. So on the accumulation side, I think a lot of that is going to come down to kind of current tax bracket versus post-retirement tax bracket. Essentially where the Roth is, a great opportunity would be for somebody who's in, not earning a lot of money now. Their taxes are very low today, but they're in a situation where their income could be very, very high later in life. The more traditional 401k or IRA, that's going to be for somebody who maybe has exceedingly high income today, but their retirement goals might not be, very lofty. So their post-retirement income tax rate might not be very high. The one caveat I'll throw out to that with regard to a 401k is, company matches. And, a lot of 401ks today offer both, the Roth as well as the traditional inside of them. But I think anytime we see a client who has a 401k and that 401k plan offers a company match, most typically you're going to see maybe 50 cents on the dollar up to 6%. So if you put in 6%, the company puts in 3%. That 3% is free money. So I think the first thing that anybody really needs to do is make sure you're capturing all that free money that's out there.
Okay, that's great. And
we're about probably, time. Do we have time for maybe one more question, David?
Okay, yeah, one more question. So when you have all these different types of account, which account should we draw from first?
Oh, wow, that's a great question. We see clients a lot of times, their natural inclination is we kind of look at it as, I'm a bucket guy. You've got two buckets of money. You've got your pre-tax, hopefully, and your post-tax. So pre-tax would be IRAs, 401ks, things of that nature, and post-tax would be, say, an after-tax savings account. And a lot of clients, I think their initial inclination is to spend down one bucket and then move on to the other. In most situations, it probably makes sense to be taking from buckets simultaneously. And with the goal being trying to create maybe a consistent and reasonably, low tax rate throughout retirement. So what we typically don't see being beneficial is to have virtually no taxation for a period of time and then very, very high taxation because everything you're taking out comes from that IRA or 401k. We do an awful lot of work with our clients and their accountants to kind of help determine what's a good mix between pre and post-tax dollars. And again, like so many things we've talked about, it's something that needs to be revisited on an ongoing basis. There may be changes in income for your situation that we need to be thinking about, or there may be changes in the overall tax rate environment that we want to make adjustments to. There's also a lot of talk along those lines, David, of people being concerned about how taxation impacts Medicare premiums and things with charitable giving. And we do see situations where it makes sense to sometimes bundle charitable gifts into maybe 2, 3, 4 years worth of gifts into 1 year for a tax purpose, or where maybe it makes sense to take a significant amount of money out of a qualified IRA 401k in 1 year, so that in 2 or 3 or 4 years you can have relatively small amounts, if there's a specific goal from a Medicare planning perspective. But that's something that we work on with the accountants on an ongoing basis, with our clients to make sure that things are really being looked at comprehensively.
Okay, great. And yeah, I did record some other questions, and so I know who asked them, and I have them recorded. So we might not have time to get to them today, or there's some clarification that we would need to ask because they are a little more specific to each client situation. So we will follow up with you to make sure those questions get answered as well.
Perfect. And just to kind of wrap things up, I will put a plug in for our upcoming webinar. We have one on charitable giving strategies, and that's going to be on December 3rd at 12:30. If you don't receive an email directly, you can always sign up at our website. And again, I'll kind of replug some of the webinars that we've done historically. That this one will be added to the list. And if you go out to our website at the bottom of the page, use that little YouTube icon, and you'll be able to see some of the ones we've done in the past. So with that, I really appreciate everybody turning out, and hopefully the information was on point and useful. So thank you very much and have a great rest of the afternoon.
Thanks, Brad. Really great information.